Hi there, everyone, and welcome to this week's market update. Now, don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. Okay, so the chart that you have in front of you here is the chart of the XJO, and it's the top 200 stocks of our market. So at this stage today, our market tried to rally up through that 71.80 support level, but failed. Okay, so that is for me the key level for this market at the moment. You can see here why, right? We used it as resistance back here, support many of times through the bottom of the channel in the last sort of almost 12 months here. Uh, that level obviously broke in January. We thought that, that was on the back of a lot of the Fed announcements and issues around the Fed. But, we thought that was all over. We got back above that level, inside that range again. But the whole Ukraine-Russia situation has broken us back below that level once again. So what we're seeing here is very early signs of a potential bear trend. Okay, we've now got a lower trough than the previous trough, but the jury's still out. So we're at a bit of a key pivot point, although we are a distance away from ours. If the US markets are a little bit different in this regard, but looking at ours, if 68.40 or around the 68 level, if that breaks and we close below those types of levels, then we will be in bear market territory. So that is something to be a little bit worried about at the moment, but too early to call, right? Way too early to call. Getting across the US markets, though, it's a little bit different. Okay, so getting across there, the S&P 500, they are quite closer to a bear market. In fact, intraday they did go into a bear market territory. So you can see here you got a lower trough, lower peak, lower trough. Okay. Now, only reason why I'm not calling it a bear market just yet is that it only did that bear market move intraday. Okay, it didn't close below that level. If it closed below 42, then I'd be talking very, very differently. There is still a risk that this could play out, though. Okay, so just for all the technical analysts out there, 40 around 42 is a very, very key level, right? If we close below these types of levels, we close down these types of levels, we're technically in a bear market for the US. I doubt that's going to play out, though. I'm in the headspace at the moment that I'm doubtful it will play out, but it's on the table and we need to be aware of it. Okay. At this point in time, the momentum switched back to up. I suspect we might get one more sort of bullish day out of this, maybe. Okay. And then we'll be back to that downtrend line. We'll see what happens from there. I suspect while this Russian Ukraine situation is playing out, we'll likely hold that 200-day moving average as resistance. I think that's going to be the theme for the coming days or weeks, depending on when this concludes. Uh, so just keeping an eye on that level, just keeping an eye on this pivot level that we're at the moment, with that potential of a bear market that's on the table right now. Okay, so as I said before, markets at a key pivot point. We'll have to wait and see how this plays out. Now, if any of you that haven't heard this terminology of pivot point before, it means the market's at the key level where it's going to determine the next phase, in a sense. That's probably the easiest way of putting it. So if the market does break through those support levels that I highlighted before, it means the market will be in a bear market, which means we would expect that bear trend to continue and the market could fall off quite a bit more. That's in vast contrast of what we've had since the bottom of COVID, which has been a bull market, and the market's been in a bull trend ever since. Okay, so we are at that pivot point. One or the other could play out. There's no certainty from a technical standpoint just yet to say which one will play out. We're just or sort of on the sidelines waiting. That's determining the medium to longer term trend. In the short term, there's still plenty of trading. Don't get me wrong, right? Current momentum's up. Then once we start hitting resistance levels again, there's the opportunity to switch back to short again, right? So there's plenty of short-term trading out there. We've still got short-term trades going out to our clients at the moment, but we are at a pivot point, which means you're going to be ready to change your view at a moment's notice. All right, so as I mentioned before, the main controlling factor of the market in the short term right now is this whole Russia-Ukraine situation. I don't need to explain what's going on. I'm sure you would have read plenty out there in the media. What I will say, guys, is I suspect that in the short term, we'll see plenty of volatility. We saw it today. The market jumped. jumped more than what the futures were expecting. Went from 7,000 all the way up to 7160. It's 160 points in one day and reversed almost half of it. That's the type of volatility I will expect to happen in the coming days or weeks. The direction that happens in is all going to come down to the news flow, right? How much worse is this going to get? Okay, are they going to keep talking nuclear? The second that Russia brought that to the table over the weekend, we saw the US futures when they reopened Monday morning. Dow futures down 600 points, bang, right? That's the type of news we don't want to hear. I think the market's okay at the current levels with the whole situation in Ukraine, but any further escalations, we could see the markets dump off. So short term, I suspect a lot of volatility, a lot of whippiness. The mood's going to swing from day to day depending on the news flow. Medium to long term, guys, I'm quite bullish still, right? Nothing's changed for me. The next hurdle's interest rates. So we're going to see the Fed announce soon. That's going to be 2 weeks' time, middle of March. We suspect they're going to increase interest rates. A whole Ukraine-Russia thing might adjust that slightly. We couldn't be 100% sure at this stage. But I think the market's more than priced that in now. Interest rates are fine going up as long as they don't change the rhetoric to too much more hawkish, right? We don't want to hear them running off their balance sheet too early, straight after increasing interest rates, all right? Inflation's obviously the issue here. That's going to get worse because of what's happening with Russia and Ukraine in the energy space. So once again, increasing interest rates is not going to fix this problem. This problem is caused by now a combination of what's happened with COVID. We've got a supply problem in the oil and energy space, and that is not going to be fixed by increasing interest rates. Okay, it's just going to slow the economy down at a time when we're coming out of a COVID pandemic. So look, I don't think they're going to go too far with interest rates, guys. I honestly think you'll get some interest rate hikes out of the US, which is probably a healthy thing to do while the economy is strong. Put some ammunition back in that barrel again, which they need to do because they're near zero interest rates right now. So regardless, they do need to lift the rates a bit, but we don't want them to go too hard too quickly. That will spook the markets once again. 0.5% in March is okay. Them talking maybe 4 to 5, which is already priced into our markets, is fine. If they start talking any more than that, I think the market will crash off. So COVID cases once again this week fell. Okay, so for the last 4 weeks consecutively, it's fallen. It hit 24 million per week at one stage. We're now down near the 10 million mark. This for me is extremely positive. If this trend continues, hopefully we'll slowly start seeing the supply chain issues resolve over the next 6 to 12 months. Bring the inflation back down, and therefore the pressure off the central banks to lift interest rates. And I think that's kind of the theme for this year. Things will reopen, people will move around, and then hopefully supply chain issues resolve. So really, there's not too much more to talk about here. The RBA met today. There's no signs out of the RBA in increasing interest rates at all at this point. We might get something later in the year. They're looking for consistency in inflation between 2 to 3%. I understand before the pandemic, we had almost had a deflationary issue. We had very, very low inflation for a very long time. So the fact that we are now inside that 2 to 3% range, or even getting to the top end of that, it does not mean that the average over a period of time is in that range. And I think that's what they're alluding to here. Right? The RBA is in a position where they can wait, where the Fed has got a bit more pressure on them. So it's going to be interesting to see. I don't expect interest rates to go up out of the RBA until the second half of the year sometime. So that's still quite a distance away. A lot can happen in 3 months' time. I'm predicting maybe August or September, and we'll soon find out how that plays out. Later this week we will see from CJ Powell talk. Right, that could affect the mood of the market a little bit. It'll be interesting to see whether he backpedals a little bit on the hawkishness we've seen from the Fed over the last month, on the back of what's happening in Russia and Ukraine at the moment. So we'll hear a bit more news from them later this week. But as I said, the short term of the market is going to really revolve around news flow. The volatility is high. We're going to have a knee-jerky market in the short term. But then once a lot of these issues clear or the market finally prices it in, then I'd be fairly bullish from here, guys. Okay, I do think by mid-year we could easily run back up to all-time highs. All right, so that's my view at this stage, guys. Obviously, it's a moving target. I could be talking very differently in 7 days' time. In this environment, things can change very quickly. Okay, so that's where we're at. Thanks for listening in. Take care, and bye for now.